Papers are due Friday. Just so a couple more examples from previous classes. This is one on Costco. Make sure you say something. Don't start a paper with my risk-free rate is, who's the company doing? Give some background on the company. In this paper, I'm going to, set up the paper. Some students like jump right into it. That doesn't look good on LinkedIn. The person opening it should know what you're doing. So here they give a quick description of the company and say, in this paper, I'm going to be doing this. Then talk about the risk-free rate, did the chart like I suggested on 10-year on treasuries, market risk premium, use the charts I gave y'all on the economic and earnings growth. Then he did a discussion on productivity. He did quite a bit on productivity, labor growth, and inflation. Probably more than you need, but you could certainly do those things. And then he came up with his final recommendations on the risk premium. Then beta talked about the type of company is it cyclical or defensive? Then use the margin standard deviation and then debt, and talked about those. Make sure on the margin, you don't just talk about this, but think about the firm. Does it have high fixed costs? Does it have high variable costs? Do some subjective analysis. He did what I suggested, is to have a beta summary. So you make sure you bring all those pieces together. He used a pretty high beta for Costco. 0.7 is pretty high, but that's what he justified. Your final discount rate. And then he's done with paper 3, and then he jumps right into paper 4, which is long-term growth. And then short-term growth. He talked about, he had some charts that you can probably get out of Statista if you use them. If you're trying to see, if you're a retailer, Costco doesn't have nearly as many stores as Walmart or even Sam's, and is not outside of the United States. So you can use those as growth opportunities. Anything that adds strength to your paper. Like if you're doing a utility, obviously right now utilities are talking about AI and all the energy those required. And some of these utilities have specific contracts with Microsoft and some of these firms, Apple. That's a huge growth opportunity. You could certainly find articles or quotes. Anything that helps with that short-term growth helps you. But he did the same thing we talked about, was the PEG ratio and sustainable growth and the historical growth. He put some time in the half-life. A lot of students get no credit on half-life. It's a very small part of the paper, so it doesn't kill your grade. But if Costco is going to grow fast, how long is that going to last? So you have to put some thought into that. That's extremely subjective. Then on valuation, something I highly recommend is that you put the formula into your paper. There's some students, I see all their assumptions. One thing I see with students is their assumptions keep changing in the paper. So at one point, their long-term growth is 4%, and then suddenly becomes 4.5%. So like they'll justify 4%, and then they'll get their discount model and say, so using a 4.5% growth rate, I'm like, well, which one's the growth rate? Which one's the beta? So they keep changing, and I don't know which they're actually using. So the two models, the H model and different discount model, you get full credit if you just crunch the right numbers and get the right answer. But if I don't see the formula, I can't even give you credit for that. So I at least give you credit for just being able to plug numbers into the formula. But here he showed me exactly what his assumptions were, so I could back into that number. So, and then a final recommendation, this is probably where he lost a few points. You can certainly get much better on this, some kind of table or something. What's the current price? What's your valuations? What are you recommending, a buy or a sell? He's putting a sell in Costco, which I would as well. I don't think I'd ever short Costco. I just love the company too much, but I do think it's a very expensive company. But that's his final recommendation. So there's one paper. Here's another one on Johnson & Johnson. Again, an introduction. Not a real good job of saying what he's going to be doing in the paper, but still an introduction. I do prefer full justification to left justification. But if you do full justification, make sure it's full justification all the way throughout. Same thing, risk-free rate with the chart. I mean, it looks almost identical, right? They're following the video very, very closely. He has the revenue sensitivity, operating leverage, has the chart. If any of y'all have the Debt to equity with an error message here, let me know, because you're going to need debt to assets as a replacement. So if your firm doesn't have net worth, like McDonald's or someone, you'll have to get that file. I have that file at somewhere. I don't think I put it on Canvas for y'all, but if you have an NA here, that means that their net worth is negative, so you don't have a ratio. There's the rolling beta. Make sure you have the rolling beta. Make sure it's well highlighted. I mean, it's a pretty chart. The chart looks wrong, you can send me your Excel and I might be able to figure out. The one issue I've seen with the historical beta is not getting the months aligned correctly. So instead of doing April and April, May and May, May and June, they're doing April to May, May to June. They don't have the months. So if you get a beta of like 0, you probably don't have the months lined up correctly. It gets really confusing, and if you get the data from Yahoo Finance, because they have, like, instead of April 30th, they have like April 1st. And so it's April 1st. Is that April or is that March? It gets really confusing. So you got to need to make sure you line up the two. You can somewhat do that just by looking at the last month. Look at April for your stock and the market. Make sure you got those lined up, and then everything above would be lined up. But you should have a good, I mean, they did a good job of making it a pretty looking chart. Then they did the same thing with the summary at the end, what each one of those things tell you. 0.55 for Johnson & Johnson seems about right. It seems all right. Remember, Johnson & Johnson's the only remaining, one of the few remaining AAA companies out there. So obviously their financial leverage should look pretty good. And then the growth rates, short-term, they started with short-term growth rate. They looked at the historical. Remember, you can get that out of Capital IQ. They did it as a chart. You can't really do that. Well, you could, be a little tough, but Johnson & Johnson has a lot of history, so they're able to go back really far in time and do that. And then the H, they do that. I don't know whether they did long-term growth. It's probably in there somewhere. And then their valuations, again, they showed the numbers so that I could double check. And then if you show the numbers, you get the right answer. That gives you a real easy 100% credit. And then the recommendation, they show the valuations, they show the current price, and then they're recommending a buy because both of their valuations were higher than the current price. When you take my security analysis class, we'll talk about the football chart and how you want to line that up. That's pretty important. Our CFA research team did that on their case, and I think it helped them quite a bit. The judges that you tend to, that football chart tends to be the last chart you show when you're making your final recommendation. Because what the football chart does, it shows you your upside potential versus your downside. You're not doing as many scenarios, but if you want to put in a data table, you're perfectly welcome to do that. So I don't know if I have a volunteer for Wednesday, but if anyone wants me to grade their paper on Wednesday, send it over to me. Both of these papers were very strong papers. This looks very professional, doesn't it? I think it looks better with full justified. Be careful on the paragraphs. These are okay. They're a little bit long, but be careful on the paragraphs. But very professional. He did a really good job at cleaning up the charts, making them look really good. So, all right. Any questions on your papers? Everybody's good. Let me get the people here. Morris. Wow. Okay. Team 1 is almost all here. Sophia will be here. Diego. Devin. So all of team 2? Nope. Both teams missing somebody. Dylan. Sebastian. Justin. So team 3 is not all here. Team 4. Let's just give them the prize today. They're all here. Matthew. Andrew. Team 5's all here, right? Nope. Missing Matthew. I don't think we've not been missing Matthew, have we? I've seen him. Maybe he's online. Reed, Alyssa, she'll probably be here. Oscar, I haven't seen him. All right. So teams 3 and 4 are really close. And I probably should have warned y'all last week, but I'll warn you now. On Wednesday, that team case is worth 2 points, not 1. So if team 4 gets it right, it doesn't take much. The difference between those two teams, if I can find it, is very close, 0.4, 0.37 difference. So you got to learn it anyway, right? So you should get 100%. So why not? So you're really, really close. We've had several semesters where it came down to the last week. So the last class. So we'll see. All right. So we're going to finish up with options. And then we're going to do some reviewing on options and make sure you're ready on it. We just had one last one to do. And that was a strangle for a strangle. Anybody remember the strangle? Well, a straddle and strangle are essentially the same thing. It's just whether it's at the money or out of the money. So for a strangle, I don't know what stock we'll do it on. We could try well, man, what's in the news today? Rite Aid. I'm amazed they're still in business. Have you ever been to Rite Aid? So they're more northeast. Yeah, they've been in bankruptcy like their entire existence, it seems like. Um, yeah, I don't know. Let's see. We want something, and I'll show you why this is so important, is for a straddle or strangle, you're hoping for volatility. You want a stock that's going to move a bunch. You don't care if it goes up or down. You just want it to move a bunch. That's why you get that V, right? You lose money if the stock doesn't move. So let's find a stock that's moved a bunch. That is actually a reasonable stock. Yeah, it's too small. We could. We'll see if they have options. That's going to be kind of the challenge. I am interested in Duolingo from an AI standpoint. That's not it. One down. All right, I can say, man, that doesn't look like Duolingo. We'll see if they have options. We'll go out, say to let's do August. So usually strangles, you're not going to go out 6, 7 months. It'd be way too expensive, but we can go out a little bit. All right, so the stock's at 495. Let's see if we can get some decent numbers. Yeah, that's not bad. That's a pretty wide bid ask, but it's not terrible. So we'll try it. So their stock price, let's just say it's 495. Be real careful. Students will say, wow, that's an expensive stock. Don't say that. It's not an expensive stock. Yeah, it's a high stock price, which might limit some small investors, but they could become a $100 stock tomorrow just by doing a 5-to-1 stock split with no harm. So I hear students say that, wow, that's a really expensive stock. And it's like, no, it's not the way to think about it. All right, so 495, does that make sense? That's pretty close. So we'll do a straddle. So you notice it's real expensive. So if we look at their stock price, say 1 year, yeah, they've really jumped up to 495. They were just recently at 300. 495 is the top. But with the strangle, we want to be somewhat symmetrical. I'm thinking we try 400 and 530, but let's see if that works. So 530s. Well, let's try 520. So 520, the bid is 33.20. They asked the 35.90, but we'll have to see on that. So what did I say? 520? I can't remember what I just said. 540, 520. So call, strike, 520, premium. So do we want the bid or the ask? The ask, you're buying. So in strangles, you're buying the call, you're buying the put. You can short a straddle, but That's pretty dangerous. We'll talk about condors and butterflies, but 35.90. So with the straddle, you're right at the money. There's not an option. Well, I don't know why the blue line's there. That doesn't make sense. We can get this to the blue line's just in the wrong spot. There we go. So there's not a 495, so we can't do right at the money. So it's a straddle, you'd either do 490 or 500. You probably do 500, but we're going to jump a little bit out of money and do 520. Now all the numbers have changed. Why did all the numbers change? Yeah, this is real frustrating. All right, well, I'll change again. 520 is 58.50. Anybody know why they changed? $58.50. We may have bogus numbers, but that's all right. Just for practice. So the put, the strike, we said what? 450? I can't remember. Something kind of comparable. So maybe usually you want the premium to be pretty close. Let's try 440, 39.40. So that would be a really, really expensive position. You're talking a lot of money here for this strategy. These option premiums actually look too high for me. 39.40. I think I'm going to change I'm going to change to 560 on the upside because it's just too expensive. So 42.30. Good way to think about this. You're going to spend $81 on a stock that's only $4.95. That's a lot to spend on options for this kind of strategy. All right, so we're buying the put, we're buying the call. So at expiration, let's say the stock falls to 250. Or it gets as high as 700. So the stock gain or loss is expiration minus where we started. So this is very, very simple. So if I give you a straddle or a strangle, it's really simple because you've already done a put, you've already done a call. All you got to do is add those two together, but be careful because the expiration value might have changed. You can't just add the two parts together because I might change the question, but the actual math you did, other than the expiration value, is going to be the same. So you got the call. The call gain or loss. You got the put gain or loss. The gain or loss, remember, is the intrinsic value minus the option value. What's the intrinsic value for a call? Someone say it boldly. What is it? Equals what? Max of what? S minus X, right? The stock minus the strike. Comma 0, that's going to be 0, but it costs you $40.32. So when I hit enter, I better get negative 42.30. When is it going to start making money? It goes to 550, what happens? Not any good. 560, not any good. 570, what I'll do? I'll make 10 bucks, but I paid 42.30. So where do I break even? Should be able to do it real quick in your head. 602.30, right? 602.30. should be break even. Go down to 600. Sure enough, at 600, starts making money, right? The put, the exact same thing, except for what? Yeah, you start with the strike, then you subtract. 0 minus 39. How is this one going to do? Well, if it falls to 250, I'm going to make 440 minus 250, so I'm going to make 190, but I paid 39.40 for it. So it should be like 150 to 160 or something, 150.60, right? And then we lose the premium at the bottom. I'll probably need to go out a little further here. Let's go out to 800 maybe. And so what is the strangle? You just add those two together. And it won't look like a V because this isn't a straddle, but it's going to be kind of a bowl shape kind of thing. So here you're hoping for the stock to move dramatically. So if we did a straddle, it would be an exact V because we'd be right at the money. But a strangle gives you kind of that bowl shape, which means you're likely to lose a lot of money on this, especially for a stock that options are that expensive. You're likely to lose quite a bit of money on this. When does this make sense? A lot of people like to do this right around earnings announcement dates because there's a lot of volatility, but that also means the options are going to be more expensive because the options are priced off of volatility. So that's that book I was recommending, Trading on Corporate Earnings Announcements. That's a really, really good way to think about these type of strategies. Questions on strangles? All right, so I'm going to test y'all, and I want everybody participating. No social media, anything else. So these are the ones you have to know for the exam. A long call, the gain or loss is the intrinsic value minus the premium. The intrinsic value is max of S minus X. Long puts, the gain is the intrinsic value minus the premium. The intrinsic value is the max of the X minus S. Protected put, you own the stock and you own a put. All right, so you already know the valuation for a put. That's pretty straightforward. Covered call, you own the stock, you sell the call. That's where you use the bid. Remember, when you sell something, use the bid, not the ask. For callers, you own the stock, you own the put, you sell the call. It's like the protected put plus the covered call. And for straddles and strangles, you own the call and the put. Right? So get out a piece of paper and write all that down without looking at your notes. 10,000 bucks to whoever gets them all right, unless I change my mind later. Might be 10,000 yen. But practice now, see how much you know so you can quiz yourself, but write them down. Just don't look at your notes. Not for the exam, this is for your life. You should know this stuff. These are the most basic ones every finance major knows. If you don't know it, you shouldn't graduate. So what is the gain on a call? Write down a gain on a call. All right, and what's the gain on a put? So on the call and put, you can type IV equals for intrinsic value. And then you see the gain is IV plus or minus whatever. Same thing on the put, IV equals. And then do a protected put. With a protected put, you can just type IV and not do the entire formula. Put them, call and put, write the entire formula out. And then once you have the formula, you can use IV. But write out for the protected put, what do you own? What are you short? Do you own the underlying? Do you own a put? Do you sell a put? Do you buy a call? Do you sell a call? So the put that down. And then for the option gain or loss, you can use the letters IV instead of the entire formula. You have the word max on the call and the put, max of whatever. All right, and then do a covered call. What's the gain on a covered call? What are you on? What are you short on a covered call? And do the gain. Right, and the next one is a collar. This one takes a little longer to write. What do you own? What are you short? And then what's the gain? So when you do IV, say the call IV or the put IV, plus or minus. Be careful when you put the minus sign. If you're short something, if you're short a call or short a put, make sure you have the minus sign with the right parentheses. And your last one, kind of the easiest one, is a strangle or a straddle. You can just put them together. All right, let's try it. So for a long call, what's the intrinsic value? You also have this by now. We've done it so many times. Say it loud, boldly. Max of what? Underline. Minus what? Right. The max of that and what? All right. So what's the gain? IV minus the premium. All right. Why do I separate the gain from the IV? The IV is just what the option's worth at expiration, but you pay the premium up front. So your gain is that intrinsic value minus your option premium. All right. Well, if you're short, it's this entire thing. So if you sell it, then it's gonna be minus that. So you sold the call. So make sure, because here you lose the IV, but you pick up the premium. So the gain is that entire thing in parentheses. And if you're selling the call, which is important for the caller and the cover, if you're selling it, then you need that whole thing, and then you just change the sign. All right. All right. What about a long put? What's the IV here? Plus minus X and what? And then the gain is going to equal IV minus the premium, just like, yeah, same. Why is that important? Because what is time value? You remember? Huh? At expiration, no, at time value today. Time value at expiration equals what? 0, but time value today equals what? The premium minus what? Not the strike. Premium minus IV. All right. So if it's out of the money, it's all time value, because there is no intrinsic value. Because anything that's out of the money has an intrinsic value of 0. If it's in the money, then you're going to have some time value. You're going to have some intrinsic value. There will be a time value question on the exam, so make sure you're practicing that. All right. What about the protective put? What do you own? So long the stock, and what else? Long a put, and then the gain is going to equal the stock gain plus put gain, which is IV minus the premium. So if you've calculated a premium, the IV, and you know that you've already know how to do a put. So when you do a protected put, all you got to do is calculate that that put gain or loss again and add it to the stock gain or loss. All right. What about a covered call? What do you own? So you're long the stock, and what else? Yeah, you short call. So the gain is going to equal what? Stock gain minus the call gain. And that's going to be minus the IV minus the premium. We're talking about call premium and call IV. So make sure you have the parentheses. Just calculate this like you do any other call. What's the only difference? Your premium is going to be the bid and not the ask. So you make sure you have the bid premium in there. And then the put IV minus the put premium. Now a collar, this one's the most complicated. What do you own here? Remember the collar? You're essentially combining the protected put and the covered call. Long the stock, long the put, and short the call. All right. So essentially combine the protected put, long the stock, the covered call, long the stock, long the put, short the call. All right. So your gain is going to be essentially the combination of all of those. The stock gain plus put gain minus call gain. So if you can do the protected put and the covered call, the collar, you're just combining those all together, pretty straightforward. And then maybe the easiest one is this straddle, strangle. What do you own here? Huh? Well, you don't own the stock. So long the put and long the call. All right. I think of the collar as almost everything except for your short the call here. And then your gain is just the put gain plus call gain. When do you use the ask? Anytime you're long something. So anytime you're long a put, use the ask. When do you use the bid? On the call. So you'll never use the bid on the puts because we don't have a short put strategy here. So let's look at some, this is a good website. Let's look at some of these hockey sticks. So a long call, we talked about a long call. If you buy the call, if the stock price falls, you're out the premium. But when the stock price starts rising, you start making money. First, it's got to hit. Let me go larger. You have to hit the strike price. When it hits the strike price, you start making some of your call premium back, and at some point you start making money. All right. That looks an awful lot like the protected put. When you own the stock on the put option, if the stock price falls, you're going to lose some on the stock, you're going to lose some on the put option premium, but you'll have a floor to how much you can lose at some point. As the stock goes up, you make money, but the stock has to go up enough to cover your put premium, and you still go. This is that put call parity. The long call and the protected put look very, very similar to each other. So if you just own the call, it's bullish because the stock price goes up. That's when you make money. The put, just the opposite. With the put, if the stock price goes up, you lose your put premium, but at some point the stock price falls enough that you start making some of your money back. And then once you make all the premium back, you start making money. All you got to do with a short call and a short put is you just flip these upside down and you use the bid instead of the ask, and then you're making money. This is very bearish. You're expecting the stock to fall, not rise. You have unlimited loss, which makes it so dangerous. That's why people like to do spreads. That's a bullish spread. Here's a bear spread. So bear spread, we'll talk about the spread a little bit. We haven't really done much on spreads, but a short call is pretty scary because you might think the stock price is going to fall and you want to collect that premium, but you have unlimited loss. If you do a bear call spread, you make money if the stock price falls, but the stock price rises, you're not completely out of money. You can do the same thing with the put spread. So if you think the stock price is going to fall, but you don't know how much it's going to fall, you can sell a put at one strike and buy one at another strike, and you can make that bullish or bearish. Either way. You can put different shapes in here. You notice here, this essentially is a straddle, but you're cutting your costs down by selling some of the downside of the straddle. All right, so you essentially say, you know, I want to sell this call, but or I want to sell this put, but or I guess you're buying the put. I want to buy this put, but boy, this is really expensive, so I'm going to sell a put farther out of the money. And by doing that, I'm going to cut off the upside of this, but it cuts my costs down pretty dramatically. So in this case, you would sell a call option, you would sell a put option, maybe at 500, and then you would buy another put option, say at 460 or something. You say, why in the world why would I want to cut this off? Because it reduces this cost pretty dramatically, right? We did a lot of put spreads at USAA. It does cut your costs quite dramatically. There's your straddle. We're talking about straddles are really tough because you have to be right at the money. It's really tough to do. Here's a strangle, what we're talking about. You can buy a strangle or you can sell a strangle. You can buy a straddle or you can sell a straddle. The problem with selling a strangle is you have unlimited loss. It's really not unlimited loss because the stock can't go below zero, but you have unlimited loss on the upside. So what a lot of people like to do is combine the strangle with a spread so that they can cut off those. But that's going to make it more expensive. But your probability of a gain is really, really high. You have a really, really high probability of gain unless the stock just really takes off. This is a very, very popular strategy. I do like this strategy. It does make a lot of sense on some stocks. It could be a great strategy for a stock that you just don't think is going to go anywhere. You get to collect a lot, but at least you limit how much you could be exposed to. Then they get really, really fancy, and I can't tell you exactly what all these things are doing. They even have a Christmas tree. So you're combining all different things. What they're maybe not showing here so much. When you do the spread, the other thing you can mix are maturity dates. So you can do 1 month. So when we did collars at USAA, the short stuff we do 1 month and the long stuff we do 3 months to try to manage that time value. This is a good spreadsheet, a website, because when you click on it, they give you quite a bit of information on how it looks, how it performs. They give you an example. So it's a pretty good website. So think through your strategies that you might like. This is not all of them. And you can get really pretty fancy by, 6 or 7 or 8 or 9, 10, 11 legs. You can do so much. It can get pretty crazy. And that's where the Greeks come in really important. What is your delta? What is your gamma? So you can understand how this thing reacts. If you're doing something like a collar, like a covered call, your gamma is going to reduce pretty dramatically as you go up, because here your gamma is how your delta changes. Here your delta is pretty good. Your delta is just telling you, hey, when the stock price falls, your option strategy falls. When the stock price goes up, your strategy goes up. What happens to your strategy here? Your delta goes to 0. And gamma is telling you how your delta is performing. So your gamma is going to look really bad right around in here. And that's going to be important to you. If this stock price keeps going up, this option is going to give me 0 value. So your gamma is going to be really, really important. So those are the most common strategy. I'm sure there's others. I couldn't even tell you how to build these. Do you want this? Does this make you happier than the nice little V? I don't know why that would. I don't. They're using. Oh, they're not going to see in that one. You got to pay for it. So they're going to say, "Hey, you like that? You have to give us some money." So, options as an investment strategy as a book. I have not read, but previous students, here it is right here. Previous students have highly recommended it. I should read it. I don't read books anymore. I only listen to Audible books. And this doesn't look like a fun book to do Audible, when they're doing a lot of numbers and charts and tables. So it's only $67 and you probably get one much cheaper used. Probably here's one that's $26. I'm not even sure if you even have to have the latest edition. So there might be on something like this, maybe a CD or something that comes with it, or Excel models that you can buy to do some analysis. One thing I haven't tried, and we're going to be doing this in the fall with the secure analysis class, is use more and more of the Bloomberg models that are already pre-built. We're going to use it for stock valuation, but I'm sure Bloomberg has some pre-built Excel files for option strategies. We won't use that in my secure analysis class, but we could certainly use this. We'll definitely use the stock models that they have. Can you imagine what GameStop options were doing on this day? I've got the data. I'll have to show it to you, but it's massive. I wish I had known. Don't you wish you had known this? You could have bought a call option like at, I don't know, $10, and it would have cost you almost nothing, a few pennies. And that option would have been worth $65. So you might have spent 5 cents and be worth $65. That's a pretty good return in one day. Pretty crazy. It hasn't come back down. I don't know how GameStop is still in business. When's the last time you walked into a GameStop? Have any of y'all never been in a GameStop? And how is GameStop going to compete with the digital and Microsoft? So I don't understand why the business is still in business, because who actually still buys the CDs anymore? But somehow they're in business. There was an article that they had some new thing that they could do that might make them some money, but I just don't see it. But the stock price still has not come back down. And some people are arguing it was overpriced down here. It's hard to tell. It really was a $20 stock back here, but they did a stock split, multiple stock splits. So the $20 now looks like a few pennies. So it's hard to actually compare on that. But yeah, so look at these strategies. The other thing to remember is the CBOE. CBOE site has some really good education in there. They even have events. I don't know if some of those are free or not. They have an index options 101. I don't know if they have certifications. I've been talking to students. Well, I shouldn't say this at UTSA, but I have students that think they want to do an MS in finance right out of college. And boy, I think you need to think differently on that. I'm not a big fan of your master's right after college. I know some students, especially international students, would do that because they just need more time, because they've got to find a sponsor. I kind of understand that. That can make some sense. My recommendation is, if you're going to do a master's right out of college, you better make it radically different than what you're doing. So I wouldn't do finance on finance, because guess what an MS in finance covers? The exact same thing you did undergraduate, the exact same things. So I would maybe do decision science or programming or econometrics or something. And I would absolutely wait until you know where your specialization is. I've been talking to 3 or 4 alums. I got a meeting with an alum tomorrow night, and I'm having lunch with one tomorrow. He was on the UTSA football team, really sharp student. So I'm really curious what he's doing now. And I am blown away at how specific their careers are. I just got an email from a student today who's switching careers into something new, but they're so specific. And they're excited because they have found their niche. Some of them are a little bit stressed out because the jobs are really, really tough and stressful, but they found their niche. Most of them haven't done masters, and it's probably good they haven't, because you really want to know where your specialization is going to be. So you might be an option trader. So we have Eric up in Chicago, an option trader. He knows this stuff so extremely well. We've had him come and speak to our classes before. A really sharp guy. He's getting married, and his wife doesn't want to live in Chicago, so he's not really sure. So I've been scared to ask him, because I'm really hoping he's still in Chicago doing options. He was a pre-med student and then switched to finance, so he's like, he can do almost anything. Sharp guy. So you don't know what that specialization is. I always wait. So one thing you can do while you're waiting is certifications. And I don't know if CBOE has certifications. I don't see it in here. But you could certainly put this on your resume by saying, I went through the educational forum on CBOE. If you want to ask for certification, the one I recommend is the Corporate Finance Institute. I'm going to try these this summer, and we might add them to our investment society kind of scholarship so we can help pay for some of these. But here's the ones I have. This is one I'm going to try this summer, the FMVA. I might try some of these others as well. Meaning everything I've seen from CFI is really, really good. That is like $300, and we might actually sponsor some through the investment society. $300 versus the CFA exam is a few thousand, and a master's is what? Ridiculous, isn't it? You're talking 5, 10, 15, 20, I mean, 60, $100,000. These are much faster and they go on your resume. And to me, they're just as impressive as the master. There are some Mickey Mouse masters out there. UTSA's is not Mickey Mouse. It's a strenuous one, but there are some Mickey Mouse master programs. I'm shocked. I don't know if y'all seen the emails, the 9-month MBA, and that's just absolutely insane. There's no way you're going to get a quality MBA in 9 months. So I try some of these. Bloomberg has added 2 new certifications that I'm going to try out this summer. So I would recommend, if you're eager to put something on your resume, I would look at these kind of things. You might try, if you're coming back in the fall, you might try with the Investment Society. We're going to try to push scholarships to pay for the certification, and even scholarships rewarding students that get the certification. So you can get these things on your resume. This one I've heard some pretty good stuff about. I'm going to try it. Dr. Agarwal thinks I can do this for free because he has a connection. I don't actually need a certification. I've got 6 certifications. I'm kind of filled up. I'm good for certification. So I just want to do it to see what the quality of it is, just to see. So, I mean, I would start adding these kind of things in there. But on the options side, there probably is a certification out there on options. You could do the Khan Academy and put that on your resume. I don't think Khan Academy has certifications. Anybody know that they give you kind of some, but so think about these things over the summer. The CFA exam is the ultimate one, and we do have a scholarship for that you can get. If you get CFA Part 1, that by itself looks great on the resume. It takes about 10, 15 hours a week of studying, so you can't be doing that with 18 hours of college, but you can get that on your resume. So these are kind of things to do. If you don't know your specialization, I would go more generic, something like this, which will fit almost any query you do. How to use Excel, how to use modeling, how to build models. That would help you a lot. The Bloomberg Market Concepts helps on that. So I would certainly do that. All right, one last thing I want to show you. I can't remember if I showed y'all that before. So on Wednesday, we're going to do the option problem. It's going to take, I'm going to give y'all quite a bit of time to do it. So if you don't come prepared, you're going to be really wasting your time. So I would study for Wednesday's team question as if you're studying for the final. So you come in here, don't be late, come here on time so you can work with your team. We'll break it up into pieces. I'll give you a call and you do all the math on that. I'll give you a put, you'll do that. Then I'll give you whatever it was on the last exam. It's going to be one of these 3: protected put, covered call, or collars, or one of these 4 or straddles. And then you have the time value calculation. You have those 4 questions. We'll do each one at a time so your team can work through it. So practice it. And then we'll know. I might just grade teams 3 and 4 in class, so you'll know going out who won. Be stressful on everybody, but we'll see. All right, and then the last thing, I don't think, did I show y'all this before? I know I showed my risk class this. So y'all remember, did I show y'all this? So you already seen this. So Joe Robles, it's incredible what you can do with options in a large portfolio. This wasn't a massive portfolio, like $1 billion portfolio, but it's a good sized portfolio. So so when I sign up for a brokerage and tell them my experience, I'll say I've done billions of dollars, even though I know my personal portfolio, so that hopefully they'll approve me to do anything. It is quite powerful. Since I left, they were struggling with this. because they were just really, really conservative, and it gets really tough. It looked great in a down market. On the up market, we debated a lot about taking the strategy off. We took it off at the end of 2008, and which is the reason we got the positive return. So it protected us quite a bit. We were down as much as 9%, even with the options, but the market was down 50%. So we were down 9, the market was down 50, and then the market recovered 10%. We had this strategy off. This was a very basic collar strategy, just like you're looking for, a collar strategy where we're selling the calls, we're buying the puts, but we did a put spread. So we bought the put and we sold a put further out. And we took that off in November. I remember meeting with Joe. My boss was freaking out. He said, we can't do this. We can't take this off. We got to keep the hedge there. And so we met with Joe, and Joe was like, I'm perfectly fine with that. He was a sharp guy. I worked with him on quite a few projects. And he was like, hey, if you buy stocks, you're going to lose money sometime. So my boss, are you sure? Are you sure? Are you sure? And so it ended up working out really well. And I'm really proud that that's the thing he chose to put in his annual report. Have any of y'all met Joe Robles before? He passed away, what, 2 years ago? So really great guy. I don't know the current CEO. I know the last 4, but I don't know the current one. So I don't know anything about him. So I can't help you with that. So if you do your job well in a stressful market, so these are my kind of markets. I love it when things are blowing up. That's when I do the best. And that was a blow up market. And so what did I do? I retired after this. So you can go out, go strong, kind of like Warren Buffett, right? He's having a great year. He's retiring. So that's a good way to do it. All right. So on Thursday, sorry. On Thursday, we'll do the option question, and then we'll talk quite a bit about the exam. We'll see our timing on Thursday. I'll walk through. I'm going to do special office hours. I can't do a review session during the dead days because that's not allowed. So what I'll do is I'll do special office hours on Zoom. And if you want to sit in on those office hours, you're allowed to, but it's not a class. Don't tell anybody we're having a review session. We're not. I'm just going to be on Zoom. I'm going to work the prior exam, which you've kind of already done because those have been our team questions. I'm going to work the prior exam. I'll put that on YouTube, so you'll have a prior exam. I would highly recommend, I can't remember if I put that on Canvas yet, but I'll put the exam on Canvas so that you'll have it in advance and you can work it in advance. So, all right, any questions? I'll stop it there, let you out a little bit early. By the time I end a class, I'll grade 3 and 4 since they're the ones still with shot. But if you're not 3 or 4, your goal is to not be last place. Which team is this? Team 2 or 1?
Oh, team 1.
1. Yes, sir. Team 5, team 2, team 5, you are out there. Team 5, or are you? Y'all there? Are your team 5? All right. This isn't like advanced options, but if you understand this, you're ahead of most people. This is the basics of it. When you get into, if you take speculative markets class, they start talking about option pricing models, which you should know, but most people forget those unless they're a daily trader. So this is somewhat of the basics. The real key is strategies, and there's a lot of strategies. And to me, people ask, what's the best strategy? And I'd ask, well, what were option premiums? Because check option premiums, what is the VIX, what are volatility, what's the market saying? So the strategy depends a lot. So I was a huge fan of options in 2020 because for older people, bonds made no sense in 2020. So I was like, just put everything in equities and hedge it. You'll be far better off doing that than you were buying bonds, because bonds could sell off. And of course they did in 2022. You would have really lost a lot. Today, I'm not as excited because the VIX is really high, which means hedging is real expensive right now. And bonds are providing pretty decent returns. So the strategy, and I'm sorry I messed up the strategy on Monday. We may talk about that again. Are we real clear how you can use the option market to execute in advance? And if what you're executing doesn't happen, you just get to keep the premium. Those are really powerful strategies. All right, so let's look at this one. So the first one's on the call. Pretty easy formula. You just have max of S minus X comma 0 minus the premium. So if you know that formula, you've got it. So here we got the stock was 145. The strike was 135. So you made $10 on the option, but it cost you $8.40. Is that right? So $1.60. All right, both teams 3 and 4 got that one. Would it be more competitive if we offered like $1,000 win to the winning team? Would students study more with money? All right, so B, the put, the exact same formula. You just switch the X and the S minus the premium. Most students do get these two correctly, so correct. So max up here, the strike, 135, 110. So they made 25 bucks on that. That's pretty good. And then they paid 10.05 for that. So $15. That seem right? Oh, 14.95, excuse me, 14.95. 14, both teams got that one. All right. C, the covered call. Well, first of all, what is it? What are you on? What are you short? Long stock and what? Short the call. All right. So the stock, it was trading for 132. At expiration, it's at 150. So the stock's up 18 bucks. The call, the same formula, equal max S minus X comma 0 minus the premium, except for here, the premium is what? It's going to be the bid, right? So the stock at expiration is 150. The strike was what, 135? And what's the premium here? It's not 840 anymore. Now it's 810. So you do that just like you have a long call. The only difference is you change it. And then what do we do next? So you're short that, so you just subtract the entire thing, right? When you do that, get 1110. Uh-oh. Team 4 got that one. Team 3, what happened, Team 3? How did I get 810?
Stock price is the thing negative. You're losing.
Yeah, okay.
Yeah, we have still that the strike price is one.
Yeah, something happened. We'll see if that's enough to get Team 3 and 4. We'll have to see. We'll make each one of these worth 0.5. Well, how big was the difference?
I think these should be worth it.
Oh, yeah. That one question worth 80 points. Let's see, what is the difference? 0.5? Ooh, that would be enough. We'll see. All right. All right, and then D, time value. So the intrinsic value is what we've been doing. The only difference between that is you don't subtract the option premium. So the intrinsic value for this option, its strike was 135 and the stock's at 32. So what's the intrinsic value? Equal max 132 minus 135 minus 132 and 0. So the intrinsic value is $3. What's the option premium? It's 10.05, right? The time value should be 7.05. That sound right? Ah, we'll see. It looks like 4 might have pulled ahead there. So was that the press 3 a whole lot? It probably won't have any impact on your grade, but it might. I'll see. All right, we'll see. Pretty close. One question. That's life, right? All right, I'll put this back out there on Canvas. All right, so let's do the smart grade. It's hard to do the smart grade, but you want to take a picture. Here's how I grade. This is how I grade papers 3 and 4. There's 10 things or 10 points I'm looking at to get full credit. So I look for, is there an introduction? Introduction can be a couple of things. You say, who is the company? High level. And in this paper, I will. That's the kind of thing you want to do in an introduction. So the person doesn't just open up the paper and you just start talking about beta or something. This doesn't work. I was talking about good old Kahneman when he spoke at a graduation, and he just gets up there and starts talking about prospect theory. Doesn't congratulate the graduates, doesn't say anything to the parents, does anything, just starts talking about prospect theory. You can't do that in the paper. You got to let your reader know why you're writing this. So start that off. Risk-free rate, pretty straightforward. Market risk premium, we talked about that. A little bit more involved, but there you're going to be using the implied approach. Then on your beta, there's quite a bit on betas. So you need to talk about what kind of firm is this? So that's a subjective discussion. Is it a cyclical or defensive? I might disagree with you, but as long as you're logical, you'll get full credit. The operating and financial leverage, there's a little subjective there, how much fixed cost is in their structure, but then you look at the volatility of their margins. The financial is pretty straightforward. You just look at their debt to equity versus the market, and that's a pretty straightforward one. You need to do the beta chart. Some students don't do the beta chart. You need to do that. The paper I'm going to show you, they're doing a company that they can't do the beta chart because they don't have history, so they're doing a proxy company. You can do that. In some summary, I do look to see if you include all 4 of these in your final beta. So having that summary chart that shows all 4 steps helps on that. So there is essentially paper 3, paper 4. You need some discussion in long-term growth, even if your long-term growth is exactly what you use for the market risk premium. You need to at least bring that up, at least mention it. So in paper, previously I said I expect corporate earnings for the stock market to grow at 5%. I think my company is in line with everybody else, therefore I'm going to use 5%. You need at least some discussion like that. Short-term growth, we gave you quite a bit to do there. You got the PEG ratio, you got history, you can look at Bloomberg, you can look at the sustainable growth model. There's several things you can do there. The H is entirely subjective. Look, it's not many points. It's only 2.5%, but some discussion on how long you think that short-term growth is going to persist. And then the easy points are the 2 models. Here is, can you plug, I may disagree with every single one of your assumptions, but if you can plug them into the model and get the right answer, you get full credits. Where can you lose points? Where if your discount rate's lower than your long-term growth rate, you get a negative number, I'm going to take off points. You can't get a negative number. So your growth rate has to be lower than your discount rate. Make sure in your paper that you give me the formula with your numbers in it, because some students have problems in the paper. They keep changing their mind, or if they got to edit something or something. So let me know, because you get full credit. As long as you can plug numbers into a formula, do your parentheses correctly, you get full credit. So those are like the easiest points. And that by itself, oh, that's like 17, almost 20% of the paper. Your final recommendation, make sure there's no way you can do the final recommendation if you don't talk about the stock's current price. I've had students do that. I recommend, I think the stock's worth 150. I recommend a buy. You're like, well, what is it currently trading for? 20 bucks or 300 bucks? You can't, it doesn't make any sense not to put that in there. Those taking my security analysis class in the fall, you'll be doing this for a bunch of companies. We'll be going pretty rapidly. We're going to build it. And I'll show you pretty early in the semester how to build this. So much, because we're going to be in the Bloomberg room, much of this you can build so it's linked to Bloomberg. So you're not recreating this. You did this following the video, but a lot of stuff you're building, you're having to rekey it. Things like the free cash flow per share, that you can pull from Bloomberg. You don't have to calculate that. And there's some of the things, obviously, like the risk-free rate and the market risk premium. That's going to be true for all your stocks. So once you have that built, that just feeds to all the other companies. Some of the stuff like the long-term and short-term growth, those are kind of things you can quickly set up. So you try to do what you're doing in papers 3, but do it so you can do 3 or 4 companies pretty quickly. All right. Any questions on that? See how that works. So let's look.
You don't vote essays.
I would make it all one paper, because when you put it on LinkedIn, you don't want this to be two. I wouldn't even talk about it as 2 papers. Don't say this is paper 3, this is paper 4. It's one paper. Only reason I do it is 2 papers because it's worth twice as much as paper 1. But do it as one paper. So when you put it out on LinkedIn, this is a really good paper to put on LinkedIn. It really looks like finance more than anything else.
If your reporting growth model figure is like a bit of the actual price.
Yeah, that's perfectly fine. What most students do is they fix their assumptions so they get closer, but your boss shouldn't pay you much money if all you're going to do is back into the current price. So what you need to do is almost better to value firm without looking at the current price, and really sit there and think, what do I really think this firm is worth? So the best approach, the worst approach is you get 20 bucks for $100 stock, and your first question is what I did wrong. What did I do wrong? That's not the right solution. So you want to make sure you don't have an error, but the first question should be, where do I disagree with the market? Is my beta too high? Am I thinking this firm's riskier than it really is? My growth rate's too low? Is this firm really growing, or is the market just really out of line? That's how you add value as an analyst. If you want your boss to pay attention, you say where the market is getting this wrong is. That's where people perk up when they hear you have a strong theory. So don't do that. It is possible you have an error, and you should look at that. Where's the error going to be? Well, the most important part is that denominator, KE minus long-term growth, because small changes here have a huge impact. If this is 6% and this is 5.5%, changing this to 5.4% has a huge impact. So that's the biggest part right there. What influences the KE? Well, remember I said put that stock buyback number in there. That was help to get you a higher KE. But it's possible your beta is way too high or way too low. It's hard to say. You really can't say where you disagree with the market because there's too many moving parts. But this is the most important function right there. The short-term growth, that generally is going to add 10, 20% to your price. But if you're off like 80%, it's in that denominator right there. All right, y'all got that? So if we look at this paper, I may not be able to fully grade it because when I do these at home, I have your papers on one computer and I got the grading on the other, so it makes it a lot easier. So this paper determines the appropriate discount rate and intrinsic value for Airbnb. So here he says what he's doing it. He gets a little bit, if I were he, I would add something in this paper and turn discount rate for Airbnb, comma, the, I don't know what you call them, but, give a definition of the firm right after that and then get into the rest of it. Most students, they start with who is the company and then what am I going to do? So Airbnb, the blah, 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 blah is, blah, blah, whatever. In this paper, I'm going to like this. So I think he kind of does that here. I really think, I'd probably give him 80% of that. I really think he needs a real clear definition of who Airbnb is. Now, where can you get that? Well, it's got to be in your own words, but you don't have to get really, really fancy on that. Wow, was Biden? That's the first time I've seen Biden, not Trump in a picture. So you can definitely go to their profile. Their profiles are way too long. It keeps, I hate it when it does that. Stop. So the profile, Airbnb with its subsidiaries, you don't need that. Operates a platform that enables hosts to offer stays and experiences to guests worldwide. It's really awkwardly worded. Its marketplace connects hosts and guests online through mobile devices to book. Yeah, you can probably get a much better definition than that, but there is a definition. I've always found their definitions is way, way too wordy. I do this when I write your exam. I actually copy and paste this, and then I take their 80 words and get it down to like 12 words. So you don't need much. This is too wordy here. All right. So give us a definition of the firm. He starts off with beta. So he's explaining why is he using Expedia as a proxy. So most of y'all won't need to do that because your firm can do beta, but you had to do that. So he's starting off with the beta. That's fine. I would start off with the risk-free rate, but if you want to start with the beta, there's no real rules on that. He's got his historical beta. This is Expedia's, but he's using that as a proxy. He's got the financial leverage there. Yeah, so if I were you, I would make it real clear, at least to help me out, which of these that you're doing. So the chart looks good. The revenue he does talk about. I would probably, so it's just, I might ding him a little bit on organization. I would probably start off with the revenue side. Who is this company? That to me just makes the most sense. In fact, I would probably start with, not even mention Expedia. I'd probably start with Airbnb. They're in the travel and leisure business. That's a high beta. It's a cyclical business, obviously. So I'd start with that. You get full credit if you do that. Then I would do the operating leverage, the financial leverage, and then I would put this proxy for Expedia probably fourth. All right. That's subjective, right? Me as the grader is just what makes more sense. So he might disagree with that. That's fine when he puts it on LinkedIn, but I might ding him a couple of points on the clarity at the end, which won't hurt him that much. But he looks like he's got the pieces. It's just a question of does it flow naturally? Yeah, so he has a good discussion here. It's just I have to kind of hunt for it when I'm trying to grade it in class. That makes it a little tough. On operating leverage, the key there is you got to do more than just a chart. So he's got the financial leverage, further increases its risk, while the company remains a relatively flexible its investments. Also means, so one thing here to make sure if you're going to show this chart, make sure you discuss the numbers. So their debt to equity is 29%, that ranks 32%. I'm not seeing that in his discussion. And I might miss some things. So don't show this chart and then don't reference it, okay? So 32%, it's below average. He says maintains a relatively flexible capital structure. I'm not real sure what that means, but he talks here about the operating leverage being high fixed costs. So I really think on financial leverage, he has the words, but he never references the chart. One thing you never want to do in a paper is put a chart that you never talk about. Because then your boss says, why is it here? All right, so he's got a chart where I can't see it. He may have if I go through, read it more sort of carefully. So same thing with this one. He's got the margin. His margins are volatile. He says that, he explains it well, but he never references the numbers. So he just needs to reference the numbers. So don't put that chart in. I'll give him 80 and 80 on that. There's that. And let's look at the closing side. I'm grading them pretty hard just because I want to stretch y'all out a little bit. Let's see, his final beta. He shows his final beta 1.7. So it's hard for me to tell, but so I might say 90 there. I just maybe an 80 there, might be really harsh. So he gets to 1.7. I can see why 1.7 is logical from his discussions. But he has this discussion, then you skip all these paragraphs, and then he says 1.7 without really letting me know. That's how that summary table really helps a lot, right? I think that was what would help him if he started with the risk-free, then the market risk premium, and then the beta discussion, so that he gets to that at the very, very end. But anyway, so it's fine the way it is, but it's more confusing to me to read it that way. All right, then he gets in the risk-free rate. It's 4.2%. He's got the chart. Most people get full credit there, market risk premium. He gives a number up front, which is a good approach. He talks about the components. He has a good quote from the Fed today. He has the charts in there. That looks very strong to me. So 100 on both of those. Most students do pretty well on that. So there's his paper 3. So he's got an A on paper 3, but he could certainly increase it with a few adjustments. Any questions on that? So it's a strong paper, but I'm kind of dinging him on just organization. All right, and then let's go on to the growth. Using 10% discount rate. So constant growth of 5% aligns to expectations. So he's talking about it. So I'm not real picky on the long-term growth as long as you give that to me. Some people on Airbnb might say, the economy's growing at 5%, but this Airbnb's in a really strong growing market. Remember, the long term equals the short term and the terminal growth. So if you think the terminal growth is going to equal economic growth, then your long term will be greater than the terminal growth. Why? Because your long term is both of those. It includes your short term and that terminal growth. You say, well, the terminal growth eventually going to grow like the economy, then the long term you're using your dividend discount model needs to be higher than that. So if he thinks they're going to be growing really fast for the next 10 years and then go to 5%, then their long term rate might be 5.2, 5.3. So it gets a little tricky on the long term. But okay, let's see how I did on the short term. So there he has the dividend discount model. He has his valuation. I don't see the formula, so it really does help. It puts the formula into it. What I do, he's got a 10.32% discount rate. I actually put the pieces in there. So dividends per share or cash flow per share. What is that number? I don't see that. So put all those components in there. I just don't see it. So yeah, put the formula in there. So y'all can see what I'm doing to give you credit for the formula. I'm putting all your assumptions in and see if I get the right price. And if you don't give me those, or if you make me have to go back and hunt and peck for them all over the place, or even worse, you give me 3 different numbers throughout the paper and you don't give me the formula. Now I got to try your 3 assumptions to see which one gives you the value. And if I don't get that, you're probably going to lose points because it's just a mess. All right. So he can help me a lot by giving me those numbers. So make it really clear. Watch the paragraph length. You're getting a little bit long here. So So here, their short-term growth rate 10%. So make sure on the short-term growth, you give me 2 or 3 approaches. We talked about the peg ratio approach, and I would set that up in your paper. So short-term growth rate, let me provide some proxies. One's the peg ratio, or you can go to Bloomberg machines. One is the sustainable growth. You can look at historical growth. In my opinion, I'm going to use, and your number can be radically different than those 3. Those 3 are just proxies of what you think is reasonable. So set all that up very, very strong in there. So just because I can't find the numbers, he gets, so here's where he could really add some value. I'm going to put 25 there because I really need, you need much more discussion here. The Gordon, I just can't tell. I'll say 90, but I can't tell. I would have to do quite a bit of work. He'll probably get 100 on that because he'll probably add those details so I can tell. On the H, so he may have this other places. If all you say is my H is 3 because I think it's going to take 6 years, that's not enough. You need to tell me why you think it's 6 years. Why 6 years and not 7 or 8? This is where creative writing comes in. Just make something up. And I don't know what you can make up there, but think of something. What some people will do is they'll say, okay, who's the competition? How much is this going to take over the hotel business? Eventually it's going to be 25% of the market. Right now they're 18%. They're dominating the market. There's really not much competition coming in. I think they'll get from 18% of the market to 25% over the next 10 years because they're doing that at about 2% a year or whatever. And if you listen to the Motorin, we haven't done much to the Motorin. I'm recommending my secure analysis students to listen to the Motorin this summer because he really helps. He has a way of explaining that really, really well. So, so give me more than that. H model. Oops. Again, I can't tell, so it's hard for me to tell by plugging the numbers in there. So I'll do 90 because I'm pretty sure it's right, but if you'll give me the numbers, I'll know. And then on the recommendation, he does a good job of, actually really, really good job. He went out and said, what are other people saying? Here's my evaluation. Here's the current stock price. And he has a buy on that. And he also did a data table, which is not required, but if you do that, I will give you some extra points on that. And you see all this green in there. So seeing all of that, definitely give him 100 on that. So some weaknesses on paper 4, amazing. You can see how hard this is for me to grade when I'm going through. If I can't figure out your numbers, oh my word, it's really frustrating for me to try to figure out, especially on these 2, which is 28% of the paper. Those should be giving me points, but if I can't figure out the numbers, it's frustrating because I'm thinking it might be right. I'll try every single combination of numbers I can come up with based on your paper, and all of that doesn't help me. One thing that he really needs to do on this paper is, I don't know what the numerator is. Nowhere in here does he tell me what his free cash flow per share is. You need to tell me that. So their dividend is, or I didn't use their dividends, I used their free cash flow per share. Here's the number I got. You got to at least tell me that number. Otherwise, it's impossible for me to know if you got the formula correct. If I don't have that numerator number, it's impossible. So I know what his long-term growth rate is. I know what his short-term growth is. I know what his H is. I know what his discount rate is. I know everything except for what his dividends or free cash flow per share is. So there's no possibility for me to know if he got the I could back into it, right? I could figure out what that number was. So it's a good paper, but he could definitely strengthen it, especially on paper 4. A lot of it's just helping me out. So he'll probably get 100 on both of these. And then the short-term growth rate, let's see if he gets up to 90 on that. That would be enough to get his paper up into an A. So those are the 3 areas that are probably the easiest for him to work on. So, all right, any questions on that? So now you see where I'm in my shoes. What am I doing at in this semester? I'm grading like a crazy man because I got like 500 and something things to grade in about a week. So, and I get There's two things that irritate me. One really irritates me, one irritates me a little bit. One is I can't hide the numbers are I'm hunting them down. So that's a little bit issue with his paper is like, man, I can't tell what numbers using. What do you think is the biggest irritation I have? What bothers me more than anything in the world that makes, because suddenly a paper that was taking 10 minutes to grade is now going to take me 2 or 3 hours. What do you think that is? Starts with a PEL. Plagiarism. That's what I have to do now. Now to figure out if it was plagiarism, I got to find the source. Once I find the source, now I got to contact the student and see what's going on. It's nothing worse than that. That's just like the worst possible thing. It irritates me because it takes massive amount of time and it's an incredible waste for the student because they got nothing out of it. So that is the absolute worst. I've had that happen on these final papers, and it's like my poor cat, if he's anywhere around, he's going to leave the room because it's so infuriating. This is not so bad, but it's frustrating because it does slow me down because I'm just trying to figure out what does the student do, because I want to give you all as many points as I can, but if I can't figure it out, I'm kind of a loss. And so to give you as many points as I can, instead of taking 10 minutes to grade your paper, is now going to take me 25, and I got 500 papers to grade, so that's the time constraint. All right, any questions on any of that? Everybody's got it? All right. All right, the exam, your first question is this team question. Oh, not that. So y'all remember this question? I'll give you a company. We did this, so the team question, I'll do this in the exam review. So the exam review is going to be these 10 questions because I'm going to do the last exam, which was the target exam. Maybe I'll find another exam, but I don't know. We'll see. But that's the first question. That's the only one where you really have a little bit of essay where you have to discuss the beta that you came up with. So that's out there. Question 2, we did. Well, question 2 is that the easy one? Most, about 80% of students get 100% on that. You just value the stock. That's just plugging numbers into a formula. Do you have to memorize the formulas? No, don't memorize the formulas. You should just know them permanently. You're a finance major. Can you imagine you're pre-med and someone says, we have to learn the anatomy, human body. Is that important? I mean, I can just look that up. What would you think about that doctor? I mean, someone's dying on the plane. I'll just get out my anatomy book. I'll look it up. I'll figure it out. That would be horrible. This is your anatomy, these formulas. So don't memorize them. You should know them permanently. They're easy formulas, and it's just plugging numbers in. So that's the second question. The third question is is the bond valuation question. What do you have to do in the bond valuation? You have to show the table with the 0.5 to 1, 1.5 and 2. You have to show that. You can use those other approaches like your calculator to back into it, my formula. You can do the estimate if you want to show off and calculate duration or whatever, but you have to show me the table. Rounding is not an issue. You might be off a penny or two because you round, but don't worry about that. Don't go out that many decimal places. Go out 4 decimal places on your discount factor, the 0.9 whatever, and you go out 2 decimal places on your dollars and cents, and that would be good enough. All right. So here, that question, we did that as a team competition. You do some students really struggle on this one. They just forget the formulas, but the return question. Y'all remember this one? Right? You do the holding period return and you connect them. This is a really important question. I'm amazed how many retail investors have no clue what their portfolio has done. This is the way I set mine up. I do mine using dollar weighted because it makes more sense, but the do dollar weighted, you still have to do the holding period return. So it's still important. And then knowing what to do with the dividend. So I'll give you one of those. You get the relative value question, which is always the worst question on the exam. Always amazes me. I think this is a really easy question and students strongly disagree with me. You either gonna have enterprise value or you're gonna have price. Enterprise value goes with what? There's only three of them. What does enterprise value go with? Yeah, all the befores. EBITDA, and what's the last one? Revenue. So anything that's EV that's over anything like other than those three things is wrong. Why? Because EV is stockholders and bondholders. So the B for bondholders has to be before interest, and then revenue is before interest. Price. There's three that we did on price. Y'all remember those three? Now you don't do price to sales, right? Price to sales is over here. Revenue is sales. They're both before interest expense. So price to book, I heard that. Price to earnings, which is after interest expense, and then the PEG ratio. Why? Because the PEG ratio is price to earnings, right? Those are the only ones that make sense. Anything I give you other than EV, the EBITDA, EV, the EBITDA, EBIT, EV, the sales, and anything other than price to book, price to earnings, and I won't give you the PEG ratio. Anything other than that is wrong. If I give you EV, the earnings, that's wrong. EV is stockholders and bondholders. Earnings is after interest expense. That's wrong. If I give you price to sales, that's wrong. So which one's wrong here? EV, the earnings, right? You got stockholders and bondholders and only have stockholders there. This one's fine. Enterprise value, EBIT. This one's fine. Price, book values after debt. This one's fine. EV, the sales. So you start with that one, which one you kick out, and then you look at the industry, and I gave you that. You have to go back and look at the notes on that. If it's technology, you're going to use an earnings-based one. EV to EBITDA is probably the most popular one. If it's retail, you're going to do EV to sales. That one's pretty straightforward. And then if it's manufacturing, if it's commodity driven, and I'm not going to give you a financials. So in manufacturing, what's manufacturing? I'm talking about firms with a lot of property, plant, and equipment, heavy capital. That's not Airbnb, right? Airbnb is capital light. They don't buy hotels. They're very capital light, but heavy property, plant, and equipment are commodity driven, like materials companies, chemical companies, metals companies, energy companies, those that are really heavy, heavily, tied to oil prices, steel prices, those will use price to book. All right, so those are your choices. One of these years, I want every student to get this one right, but it just will never happen. I don't know why this question's so difficult. And then we just did this one. I mean, do y'all want me to work a different exam for the review session? Or do you want me to work this one? Do y'all really care?
Not the one you used for the video.
No, the one in the video was, I can't remember, I won't do that one again, but that was like 3 years ago. I mean, if I do another one, it's gonna look a lot like that video. So I'll pick one and I'll put it out there. Our exam's on Monday, so you don't have much time. So I'll probably do the review session. I might even do it. It's possible I'll do it tomorrow, No, I gotta Zoom. So I might do it Friday. So no one may be, I'll let y'all know. So it might be like Friday at 6 or something. And if you can jump on, you can. If not, you can watch the video afterwards. But I'll put the exam out there so that you can work it if you want to in advance. I usually do the review like on Sunday, but your exam's on Monday. We could do it that I do the review on Sunday, but I get you the exam tomorrow and you can work it and then you can check your exam on Sunday and then you can use the other video you already have. So we'll see. I'll figure it out. I'll put it in my email. But that is the exam. There's no surprises. What I don't understand is why every student doesn't make 100 on this exam, because it's like I've given it to you so straightforward, so easy. Some students say it's too much to memorize, but that argument holds no water whatsoever. There's nothing on this exam you shouldn't already know as a finance major. So you should already know it. So it's not like you memorize for an exam, you should already know it. It's like, man, I got to put my name down. Do I have to memorize that? No, you should know your name. You should know the dividend discount model. I'm not asking for much. All right. All right, so let's do one last review. And then I'm going to leave you with one last comment. So let's see. So we've been sitting here all semester. I'm real big on retention, otherwise we're kind of wasting our time here. So let's see if you can remember anything from the first part of class. So your great aunt comes to you and says, I got $1 million I just inherited from my sister. She finally passed away. We've been waiting her out here. So $1 million, can you help me out? So what are you going to do for her? What are you going to build? Portfolio. What's a portfolio? Collection of assets, which might be securities and non-securities. Securities be like stocks and bonds. Other assets could be real estate, commodities, those type of things. All right, what might you ask her? So what are 3 questions? So the why are you investing? What is the liability? And the other question is your horizon. Someone was just asking me earlier, he's writing a book on this. He's a freshman, hasn't taken a finance class. He's writing a book on this. And he was asking me about, well, why do young people buy stocks and older people buy bonds? And it's the horizon question. The horizon question is all tied to human capital. When you're young, your human capital looks like a bond. It's massive, so you can put everything else in stocks. What's your second question? What can you invest in? This is the issue of asset classes. Which asset classes are going to be on your list? Are you going to include real estate? Are you going to include foreign bonds? What's going to be on your list? What do we want to be there? It's our goal. Do we want 50 asset classes? Do we want 3? Parsimonious. You want to have enough to explain risk and no more because it's a massive amount of work. And then what's the last question? How do you execute? Now, if your great aunt comes to you, can you handle most of these questions? Now, if she's 80 years old, you know, the horizon question is a little tough, but it's not that bad if she's saying, hey, I want to leave this to my grandchildren. Well, you can invest for the grandchildren, not for her. So you say, hey, right, you know, really, you're going to transfers over their kids and they can be in there, you can put in some college fund. They're your great grandkids, you know, they're 6 months old in a year. And yeah, we can be pretty heavy in stock. So you can handle that question. I gave you quite a bit here. So first of all, what are the major asset classes? Cash and bonds or fixed income, stocks, alternatives. And some of the alternatives you might add, so you might move up real estate as its own asset class. Some people move Bitcoins as their own asset class. All right. Y'all remember how you distinguish between cash and fixed income? They are the same thing. What are those 2 risks you look at? Price risk, reinvestment risk. So if your aunt says, well, what's the difference between cash and fixed income? Well, you're loaning money to people, but cash is when you're loaning really, really short term. You don't have much price risk, but wow, when interest rates change, your income's going to move around. And so you have those discussions. All right. How many fixed income things can you bring up? Duration, convexity, credit. Which more than likely will be an alternative for most people. So that when I just throw there, taxes, structure, that's a strange one. You probably wouldn't bring that with your aunt. Inflation. So right now the real yield's getting up in the 2.5%, 3% range. So tips actually are starting to look pretty interesting. They were hard. I would have never bought them in 2020 when the real yield was negative 1.5%, but they're starting to get interesting. So this DC cuts I to me is incredibly powerful. If you can remember, I haven't found anyone that can add to the list. What did we talk about last night in my risk management class? Which of these letters? Credit risk, definitely. And what else? What kind of bond was it? Munis. So taxes, right? So those two came up, but what else came up? Credit taxes. What was the biggest issue last night? Duration. What kind of fund was he supposed to be? A cash fund, and what was it doing? Taking a lot of price risk, leveraging up. So, John last night, I mean, this is what he talks through. I mean, so that's the kind of thing you need to know. Duration is how the bond is affected by the change in interest rates, convexity by the volatility interest rates. So it's a good list. What about stocks? What do you know here? So what do those letters stand for? Beta. So is it what are the two types? Cyclical and defensive. You'll be doing that in paper 3. So here you have cyclical and defensive. What do you have here? You have US, emerging, developed, and frontier. Those are the markets you have. So, and there you got to bring in the aspect of currency, just like you do on the bonds, but not as much. And what comes after that? Starts with a C, but it's not currency. Currency is part of the US. What if instead of BUCS, it was BUSS? Don't use this, don't use C, use S. Capitalization size. How many categories we have there? Large, mid cap, small cap, micro cap, penny stocks. So capitalization. This one's pretty important because if you're doing the French Fama model, which y'all have heard of, capitalization is a big part of it. And what's the other part of that model? Style. What's the two groups there? Growth and value. Which one's higher quality, growth or value? Growth. Yeah, most people will say value, but that's not correct there. All right, good. And alternatives, what do you have here? Well, let's take the two big categories I gave y'all. Real assets, and then I gave you private equity. And there are others, all kinds of things, but real assets. What are some of your real assets? I gave y'all 3. Timber, commodities. What was the first one we talked about? Real estate. All right, those are the main categories, but there's a lot of other categories in there. So I talked to Emiliano, an alum. He's at the old USAA real estate company. He's doing infrastructure, really, really interesting stuff, real specific infrastructure. Infrastructure is an alternative. What is infrastructure? You buy some toll road, very, very predictable cash flows, kind of interesting stuff. He's doing actually, I think, laying fiber lines. No, he might have been doing, no, I think he was doing pipelines, energy pipelines. And I was asking, well, how do you buy the land? Once you buy someone's land, do you own their land, or are you just paying them rent to go through their, it's really, really interesting. He's become an expert on that. So alternatives are there. There's other things, art, precious art, those kind of things. And then PE, and then others. So are y'all remembering this? Like, off the top of your head, you can handle a conversation on that. And then execution, we talked 3 things talked about here. What kind of investor can you be? Active and passive. What's kind of the first thing you got to ask your aunt? Huh? Yeah, so do it yourself or hire. Your aunt has PhD in finance, retired portfolio manager. She's probably not coming to you to begin with, but she can probably handle it herself. Or if your aunt is, was a biomedical, scientist, she probably doesn't want to mess with investments. And then we talked about tactical and strategic, which is part of the active. So yes, this is probably the most important part of the class. The rest of it you're going to see on the finals, so you're going to get that. One last thing to leave you with is this quote from Charlie Munger, who passed away. Man, I don't know how many classes I'm in say who just passed away. Kahneman, Markowitz, Munger. So I like this quote. I constantly see people rise in life who are not the smartest, sometimes not even the most diligent. I'm not saying that about y'all, but he's saying those aren't required to succeed, but they are learning machines. They go to bed every night a little wiser than when they got up. And boy, does that help, particularly when you have a long run ahead of you. I think that a life properly lived is just learn, 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 learn. He's in the belief compounding is really, really important. Compounding your investment earnings, compounding your learning. This is, I think, so critical. It's almost like parents ask first graders, you got to ask yourself, what did you learn in school today? What did you learn today? You should be desperate. It just amazes me, students who are just like so unengaged in class, on social media. If I were you, I'd be like desperate, desperate beyond anything to learn, learn, learn. Fortunately for me, I was scared to death when I started my career. And so my only hope was to know more than anybody else. So I was, anytime someone brought me a number, it's like, where did this come from? Who calculated it? And I would go to their desk. I was sitting at their desk. They would be talking down to me because I was so much stupider than they were. Brilliant people, but I would sit there and let them explain it, explain it, explain it. And I doubt there was too many days, especially the first 10 years, I didn't come home knowing something I didn't know the day before. You just got to do that. The alums I'm talking to, it's pretty amazing what they're doing. I was talking to Jaron last night. He's working on the healthcare side doing data science, and just, which I love. If you take my life insurance class, we talk a lot about that. Is healthcare industry is in a lot of trouble. It's causing more cost than actually healing people. And that's what he's looking at. How do you look at data to see if the money we're spending, like on knee replacements, is a good use of our money, or there's another, so he's learning that industry. He's only been doing this for like a year and a half, 2 years, and it's just amazing what he already knows in that short period of time. So yeah, learn, 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 learn. So I'm your professor for life, so you can call me anytime. I might be calling you in a couple of years. I try to talk to 3 to 4 alums every week. So took one to lunch yesterday. He was on the UTSA football team, really sharp guy. Talked to Jaron last night. I'm talking to Carissa tomorrow. She's in the utility industry, really, really smart alum. So I may be calling you, but you can call me anytime if you have questions, and I'll certainly, especially call me in the morning. I'll be on a bike. I can help you. So that is what we're going to do. If you're graduating, anyone graduating this semester? This Wendy. All right. So congrats to y'all. I'll see you in the risk class. So I'll catch you there. So hopefully I'll see y'all on campus. I strongly recommend you get involved in Investment Society next fall. We're taking the Investment Society to a level we've never been at before. And we've been at pretty high levels. We just won Student Organization of the Year this year. So I highly recommend you join that. So all right, I'll stop it there. I'll let you out 9 minutes early. How about that? I've never done that before.